following on from our previous study of the major portfolio performance trends in 2020, in terms of asset classes, geographic regions, sectors and individual FTSE 100 companies, this time around we're going to look at the future and the trends that might have an influence in 2021. Now this is much harder. After all, who could have forecast that COVID-19, lockdowns, PPE and tears would all become part of the everyday lexicon for everybody, let alone investors? As such, all I'm going to say right now is I don't have a crystal ball, and none of these are predictions or anything that could be seen as investment advice, but they are big issues which professional and private investors are all thinking about and debating right now, as they could shape portfolio performance in 2021 and beyond, even if there's always the chance that some bigger, even more dramatic trend could yet come out of the woodwork. Just as we did with our 2020 review, we're going to use 5 graphics in our 2021 preview, and the first names in the frame are central banks. Markets have fallen into ever greater thrall to the monetary authorities since Alan Greenspan and the US Federal Reserve coordinated a bailout of the LTCM hedge fund way back in 1998 when the Russian debt crisis broke. Each subsequent economic or market dislocation has seemingly been greeted with ever deeper interest rate cuts and then ever greater amounts of quantitative easing. As for promises that QE is temporary on emergency measure or that the bonds acquired would be sold, well, surely we can forget that now. The only guessing game may be just how much more stimulus central banks add under whatever acronym or guise they choose, and what effect it does have on savings, inflation, economies and asset prices. In truth, no one knows, but while central banks may still feel they are still failing in their attempts to stoke consistent growth and inflation, it could be argued that they're doing a lot to fuel asset prices. The first graphic compares the aggregate amount of assets on the balance sheets of the Bank of England, Bank of Japan, European Central Bank, Swiss National Bank and US Federal Reserve, and then runs it against the market cap of the FTSE All-World Global Equity Index. Make of that what you will, but central banks are, for better or worse, likely to remain centre stage in 2021, especially as they seem to be forming a consensus that they want to let inflation run hot, although that does assume they can get it going in the first place after a dozen post-crisis years of failing. This takes us on to the second graphic, since central banks and governments have acted in the manner they feel best to provide economic support during the pandemic and lockdowns. As a result of zero or negative interest rate policies, plus a host of other initiatives involving state-guaranteed loans and QE, there's a lot of new cash sloshing around. This doesn't guarantee inflation by any means. For that, you also need velocity as well as supply of money. But if banks start lending of their own free will or at government's behest, or food prices tick up and workers start demanding more pay, there could still be a surprise. And a surprise it would be after more than a decade of low growth, low inflation and zero interest rates, especially for investors for whom the playbook has been simple in this environment. Buy long-dated assets, buy bonds, buy equity growth such as tech, and forget commodities, forget equity value, forget emerging markets. If we do get any inflation, and it's not guaranteed, as even now the 5-year forward inflation expectations in the US are still only just touching 2%, then the playbook would probably potentially have to reverse, at least if history's any guide, and providing we don't return to the galloping price rises of the 1970s. If we got a decent dose of inflation, but not too much, not too little, then cyclical and value equities, emerging market equities and commodities, all short duration assets, could all make a comeback at the expense of those long duration ones like bonds and growth equities. Cash would also become a bit of a hot potato, as well as inflation erodes its purchasing power. Now, you may think this is all academic, but it might not be. While tech has been the equity story of 2020, as many tech and social media firms have helped consumers and companies cope with the pandemic, lockdowns and new working and operating environments, cyclical growth, or value for want of a better term, a phrase, has been outperforming tech and secular growth since July rather quietly. We can measure this by gauging the performance of the 2 exchange-traded funds in the USA, the QQQ Invesco Trust, which follows the price of the biggest non-financial stocks on the Nasdaq, and the Russell 2000 Value ETF with the ticker IWN. If the line of this chart goes up, growth is outperforming. If it goes down, value is outperforming. And if anyone thinks the post-summer move is a big one, they need to look at the left-hand side of the chart and check out the violent manner in which tech and growth fell from favour and value returned to it once the tech bubble peaked in 2000. Ouch. This has potentially big implications. It doesn't mean that tech's going to collapse as it did in 2000 to 2003, but it could put a bit of a lid on it. And since tech has done so much to drive US outperformance over the past decade, maybe any return of inflation could see emerging markets, Japan, even the UK, have their moment again, as they're more export-driven, more exposed to recovery plays and cyclicals, and look cheaper on many metrics than the US equity market. After all, look at how the big six tech movers, Facebook, Alphabet, Amazon, Apple, Netflix and Microsoft, have helped to drive the S&P 500 higher. Over the past year, they've added $2.1 trillion in market cap, and that's nearly 2/3 of the S&P's total value gain. If, and it's still an if, this sextet and tech do run out of steam, weighed down by their own valuations, regulatory pressure, or even earnings disappointment, then investors may face a tricky choice in terms of country, sector and stock selection, given that what's worked so well for a long time might just not work quite so well going forwards. However, of course, should inflation stay in its box and disinflation or deflation still rule, then we could easily see the trends of the last 10 years just keep on running to the favour of tech, US and long-dated assets. There is, however, a school of thought that buying what is popular is not a recipe for doing well over the long term and, to paraphrase Jim Rogers, that moving away from the action is the best way to find the new action. And you could say that even this worked in 2020. Neither gold nor Bitcoin were garnering much press at the turn of the year, yet both had very good 2020s, both even briefly touching fresh all-time highs in the course of the year. Some will argue there could be more to come from both, especially if governments keep on piling up debts and central banks do their best to fund that borrowing through the back door with QE, zero interest rates and bond yield manipulation. And all that's thanks to the perceived scarcity value of Bitcoin and gold relative to cash. Others, skeptics, will argue neither gold nor Bitcoin have got any intrinsic value at all, as they don't generate cash, so they're not worth very much, if anything. Yet again, therefore, in 2021, investors will get their chance to pay their money and take their choice as to whether they see Bitcoin and gold as stores of value and useful portfolio diversifiers, or more trouble than whatever they may be worth. Let's see what 2021 brings, but before then, I hope that you and your families are all in good health and good spirits, especially at this time of year, which is special to so many of you. Keep well, and I look forward to talking to you again very soon.